All right. Hi, guys. This is Jeff Kamke here. So I'm doing this video to really explain further on how you utilize the policy loan feature and how you would apply this in your business or in your life and the different categories of expenses or where money is flowing away from you. Any bills, any expenses, anything you're purchasing or taking loans on. There's money leaving your family or your business right now. And this is the way to start recapturing a percentage of that and the different ways that you could do that. So I'm going to give you some visual representations of this and then show you some hard numbers so you can have a good idea of how you could implement this in your life and a starting point of where you would want to start. So we may have already started a program for you. Maybe we're talking about a program. So we should have some idea of where you're at, what your goals are, where you're at financially right now. But hopefully this will give you some extra ideas of where we can start and what we can apply this to. And just keep in mind, when I first started learning this took me several months to really wrap my mind around the way that money flows differently with a private bank and doing the policy loan feature. And even to this day, I mean, I learned this coming up on 4 years ago and been implementing it pretty much since 4 years ago in my life. There's still things that I see that I think about the old way of viewing money instead of the new way. So the new way of viewing money can really take a while to see differently and implement differently and see possibilities that are there that you're not seeing because you're still seeing it through the old way of thinking. So just know that if you don't get all this right away because you've maybe a new client or haven't heard this information many times, you're okay. You're where everybody's at that learns this information because there's a big learning curve. So just know that going in. That's why we're here for support, ask questions, strategize, and help you, make the best choices that you want based on your goals and where you're at in your life. So I'm going to do a quick screen share here. We're going to jump in. I'm going to show you a couple things visually, and then jump into some hard numbers. So what I want to do here is just give you an idea of, traditionally, this is what most people in America do. They're a borrower. And they go to the bank. We're trained early on. I can remember in elementary school, one of the local credit unions came in, oh, let's set up your bank account and get you putting money in here. So we're trained very early on to go to the bank for everything. So where we put our money, if we need more money than we have available to us, then we go there for a loan. I mean, that's what we do for a car. That's what we do for our home. That's what we do for our education. We're really not taught any other way than become the borrower. And unfortunately, the reality of that is you are a slave. In most cases, you are a slave to the bank or the financial institution. You're making payments to them. If you need money, you have to go to the master and I need money for this. Will you please give it to me? And they'll go through a thorough check to make sure you qualify, right? Not the best situation on many fronts, but that's what most of us find ourselves in. We're the borrower. So we're making payments over a period of time, losing the interest and the principal to those payments. We'll never be able to see that money ever again. And this is obviously a visual representation of that. We go to the bank, get the financing, make principal and interest, it all goes back to the bank. So you see the bank is in a really powerful position here because you have to go to them for the money and they're collecting all the payments and gaining wealth and profits because of that. And that's what we were going to shift and start putting into place for you. So the second type of financial person in today's world are obviously farther and fewer than the borrower is the saver. I know a few people in my life that are excellent savers and they're making payments to themselves over a period of time. And then when they're ready to go buy that car or upgrade, maybe a water heater or a new fridge or whatever it is, they're paying cash for that. But the problem with both the borrower and the saver is that money is gone forever. You will never see that money again. It can never benefit you in your business, can never benefit your family again. You've lost all control. It will never buy Christmas gifts for your grandkids ever again. That money's just gone. And that is an erosion of our wealth. When there's a high percentage of our income is going to make payments, and we can never use that money again. We don't have control over that money. It's really an erosion of our wealth. So that's where we're putting this in place for you so that we can start changing that and start getting a percentage of the money that's leaving your family or your business back to you. So it's growing your wealth and you can do more things with that money. So I'm going to skip through this real quick. So this is a visual of how a bank works. And we're going to start, I want to show you this so you see the flow of money that you're used to doing and how we're going to put you in the position of the bank so that you begin to get the benefits that you're giving the bank. So here's your bank. This could be, US Bank or Fifth Third Bank or whatever your bank is. And most of us are putting deposits into that bank. This could be our 401k. This could be investments. This could be our paycheck. It could be our corporate payouts, from our corporation or our business. We're putting money into the bank. We're putting a deposit into that bank. And then the bank is giving us, this is obviously an old example at 4%. There is no bank right now giving you 4%. It's obviously, laughable right now what they're giving you back, interest for them utilizing your money and making money on your money. And you're getting a tenth of a percent or whatever it is now. So, but that's what we're going to go with is the old numbers. And that's typically what used to always happen was you're getting, a decent percentage, right? But then what we do is we go to that same bank and we request a mortgage and they give us the mortgage. And then we're making payments over 15 to 30 years back to the bank. And we end up in most cases paying close to or more than double the value of the house when we bought it by doing the mortgage. And it's really good for the bank because they're making a lot of money over a period of time and you lose all that money. That money's never in your control. You can't do anything with that money ever again. It's gone. Once you make every payment, that payment is gone forever. We do that with car. We go get a car loan, make that payment back to that bank. And obviously these could be separate banks, but let's just say we're all using the exact same bank for all these for simplicity, right? So the car payments are going back to the bank. Maybe you need to expand your home. Maybe you're having children or you want to add a deck or landscaping and you'd like to go borrow some money for that. They're going to give you that money. That money's coming from the bank and you're paying the bank principal and interest back. Maybe there's some debts involved. Maybe it's student loans, or maybe it's medical bills, or maybe your spending got out of bounds a little bit and you need to kind of get things back under control. So you think that in a conventional financial way of thinking, a debt consolidation loan might be your best bet. I'm going to show you later on when we apply debt to a private bank that becomes far superior to this way, but we don't know any better, obviously. And for this example, you're seeing now all these different loans and how the flow of money is coming from the bank for the loan, and then you're making all the payments back to the bank. And even your deposits are going to the bank. So the bank is like home base, right? All the money comes to or comes out of and flows back to the bank. So do you want to be the bank where you're making payments to that bank? Or do you want to be in this position where you're receiving all the payments? All the deposits are going to you, your bank, and all the payments are going back to you, your bank. So what we're putting in place for you, or maybe already have put in place for you, is putting you in this position. You are now your own private bank. And this is the graph of how that looks. So this is, you're the saver. You're putting money, deposits into your banking program, into your whole life insurance policy. And that is giving you the ability to have a policy loan. So you're becoming a debtor and a saver when you're becoming a private banker, but you're becoming in debt to yourself. So think about it as having money in one pants pocket, and you're just shifting money between both pants pockets. You're keeping the money in your life, and you're keeping control over that money. That's one of Warren Buffett's wisdom points: is never lose control over your money or your assets. You want to always have control over it. So that's what we're doing here, is you're becoming in debt to yourself, but you're never going down to where you're in debt like you were in the other examples where you're down here to even. You're borrowing and you're making the payments back to yourself. And that is actually growing your net worth. So if you were thinking about how many car payments or the amount of money you've spent on cars in your lifetime. I know for me, I've totaled this up, it's well over $100,000. I bought a couple brand new vehicles before and a couple slightly used vehicles before. And obviously, lesser cars as you're in high school and out of high school. That is a significant amount of money for most people. And that money is just gone. It's an erosion of their wealth. They can never do anything with that money ever again. Instead, we're putting that back into your life. So it's growing your wealth. And that is a powerful shift that we're going to be showing you some of the numbers and how that works. But here's just a visual of that over time, if you've bought, each one of these ticks is a car, and that's growing your wealth. Every car payment was going and adding to your wealth. That's a powerful thing. So here's just a visual of the flow of money. So the financial instrument here, this is your whole life insurance policy that we've put together for you. Your permanent overfunded with cash value, paid up addition rider, life insurance. And you're able to take a loan against the cash value. And so the insurance carrier, for most of us, we're probably talking about One America here. We might be using somebody else for some of you. they say that, well, you've got a policy with us, there's cash value there. We will use that as collateral and give you a loan against that. We will allow that to happen. So that is what establishes your private bank, by taking that loan from the cash value. It's basically a line of credit, if you will, and it gives you your private bank. Now you can take that money from your private bank and go over here, and maybe you have debt. Maybe you have student loans, maybe you have medical bills, maybe you, like I said, your spending got out of bounds for a while and you really wanted a lot of nice stuff or something, and you can pay that debt off. And what that does for debt, debt is a liability. You owe someone else. When you run money through the private bank and you pay off the debt, and then the payments that you're normally making to Sally Mae or to, Capital One or whoever that account is with, you're making that same dollar amount payment back to your private bank. You've just shifted your debt from a liability to an asset. That debt is now able to grow your net worth and add to your wealth. That is a powerful shift. And it becomes more powerful with debt because you can, in the numbers that I've seen over the financial freedom analysis software that we have here at Private Banking, you are able to accelerate debt reduction. I've seen it probably on average about 75% faster. So you're usually saving thousands of dollars, sometimes tens of thousands of dollars in interest and years of payments by paying literally no more money than you would if you were to make the normal payments. There's no extra going on. It's just changing the flow of the money by running it through your private bank first, paying off that debtor or a portion of it, depending on the sizing here, and making the normal payments back into your private bank, and being able to do that over and over again until that debt is satisfied. That is a huge shift, and it accelerates debt reduction significantly. So that's very powerful. So the other thing you could do with your loan, your policy loan from your private bank, is go buy an asset. So that asset could be maybe a vehicle, which isn't a true asset, but we'll call it an asset. It does depreciate. So that's kind of, maybe not, but you could buy training, you could hire a mentor, you could buy equipment with that. You could do all kinds of things with that. And then you could also, the third level, which I don't have in this slide, is an income producing asset. And the income producing asset could be things like real estate, could be purchasing a business, expanding your business. My direct mentor in private banking, Tim, he's into real estate. He will take his policy loan and go put that as a down payment on an apartment complex because he's into real estate. And then the cash flow that comes from that apartment building will go back to satisfy that loan that he took from his private bank. So he could do it all over again once he's fulfilled that line of credit or that loan. That money is still working there and available to do the loan over again a second time. So that is very, very powerful. And here to expand on that, actually, in year one, you have a certain amount of cash value available, and you can take a loan on 95% or so of that available cash value in year one. So depending on the size of your policy, that will vary. So I'm going to, I can't give you a hard number, but there's an amount in year one that you can take. So let's just say it's $10,000 that you can loan in year one. Once you've repaid that loan, you have that amount of $10,000 to borrow again. But by the time we're to year two, you might have, say, $12,000 or $13,000 to loan. So when you combine, if you've satisfied the first year's loan and line of credit, you would have the $10,000 plus the $12,000 or $13,000 by the time you get to year two to loan. So it becomes powerful. And this is where you hear us say, you get to use your money over again. You're putting your money to work. So you're using the same dollars over again. That is the power of this, because then the same money that is working for you to be able to take the loan, once you satisfy that loan, that money is there again. You can do the line of credit again against that same money. That becomes super powerful when we're talking about down the road and as the years stack up with this program. So whether it's a debt, whether it's an asset or income producing asset, all principal and interest payments are going not to an outside institution. They're going back to your private bank to fulfill that loan. And you're typically, if you have a loan set up that's 10% or a credit card that's 20%, you want to make that same amount to yourself that you would pay to them. You're treating yourself just like you would the bank. So nothing changes in this example. You're still making purchases. You're maybe still doing financing or leasing. The payments are still the same. The one move that's different is you've put money into your policy first, and you've taken a loan, established your private bank, and then all the payments that you're normally making to someone else are going back into your private bank. So that's where it becomes powerful. So I'm going to get out of the PowerPoint here. I'm going to bring up another screen here, guys, and show you some numbers now of how the actual numbers work if we were to do this in real life with a car. So this example is a 41-year-old female that has bought a $25,000 car every 5 years. And we're going to go through some of how this works. So here in this first column, here's what I'm going to point out. This isn't the actual first column, it's the third column. The premium deposit. So for you, we may have selected a number lower than 25, might be higher than 25,000. It's whatever the program that we established for you. That number, in this case, it's 25,000. She's making a premium deposit of 25 of our clients. There's a 40% amount of that 25,000 that's going towards the whole life policy. The other 60% is going towards the cash value. That's the way we traditionally establish them. That's the most efficient and the most beneficial to do it that way. Sometimes we have to go more towards 50-50, but in this example, it is a 40-60 split, as we term it. So she's been making her $25,000 payments or premium deposits, if you will, into her private bank, into her policy. And she does that for the first 5 years. And for most of us that we write, for most clients, we'll drop that paid up addition cash value over funding payment off by year 6. So your payment actually drops off by 60% in year 6. And the reason we do that is because the actual whole life policy itself becomes growing fast enough that we don't need to overfund it. You could, but we choose not to because it's the most efficient with the dollars. We're all about a most efficient way of using your money. So that's why we drop it off. So just so you know that, over here is the next column is the cumulative deposits. So we're just tracking all the money going in each year into the policy, the accumulation there. We're buying a $25,000 car, like I mentioned, and then this payment here, this is a $6,000 a year. And this is broken down because the average car payment is $500 a month. The average note length is 60-month term. So we're talking about $500 a month. That's actually $6,000 or $30,000 over the course of the 5-year period here. So there's $5,000 of interest that you would normally be paying to, Ford Motor or Chrysler Financial or whatever you're doing for your financing. You're obviously paying more than $25,000 in interest for that car, unless you're getting a 0%, which is, you could do. In this column, this is the available cash. So in year 1, she puts in 25,000. The cash value available that year is 14,500. Year 2, it says 9,800 here, but you need to factor in because she took out the 25,000 from there. So it's actually a little bit more than that. It's actually 30,000 here is what it would be by year 2. So just know that. As we move over here, we're not going to talk about every column, but this is another significant column. This is if you were to do a traditional loan and make $500 a month payment every month, you're out $6,000 per year. And that obviously compounds every year. You're another $6,000 behind and another $6,000 that you'll never see again. You can never put to use for you and your business or in your life ever again. The next column here over is comparing all the money that goes into your policy every single year, the cash value as it grows and how much you can do with that. And then also that payment of the $500 a month or $6,000 a year for the car. This column is factoring in all that. So as you see here, the first couple of years, you're putting more money into it than you're getting back out. But then by year 3, you start getting ahead of the game. And that's what is so powerful as we move along here. And the death benefit is also growing over time with these policies. That's one of the kind of icing on the cake with these policies is the death benefit is increasing over time. So let's start here. She buys her first car in year 2. So it's really month 13, the first month of the second year. I'm going to grab a drink of water here. Excuse me, guys. So she's done that. She's making $500 a month payments, just like she normally would. So let's trace this down to where she would be at the end of her first, actually, let's do the second car where she's at. So she's gone through 5 years making her $500 a month payment. She's been making her premium deposits into her policy. She's made an additional $10,000 policy that year, not an additional, but she's keeping pace with doing her annual. She's put in that year's amount. Total now, after 7 years, she's got $145,000 that she's put into the banking program, into her policy. She's actually got, though, $117,000 of cash value available that year, and that's after she deducted the $25,000 for her car. So as you can see here, we've put in 145, and she's what would that be, 142,000 that she's got in cash value. So usually with year 7 is about the tipping point for these policies, where the money you've put in to what you're able to get out in cash value, or not get out, but have available to loan against, to be careful with my wording there, is the break-even point. And so after year 7, this whole program becomes a net gain for you. And obviously the net gain begins to expand. It's better and better the longer we get away from year 7, and the longer this policy is working for you because of the growth inside the policy. So continuing on here with year 7, she's bought her second car. She is now, if you look over here, if she were to do this the conventional way, she'd be out $36,000 by this point that would never do anything for her again. But because she's running it through her policy and paying herself back the $500 a month, that is accumulated to $143,553. That is a big swing in the positive direction in her life. When you factor in the loss, and she's put in 107,000 in payments, and then minus the 36 is where you come up with the 143 is the net difference between the conventional way of doing it and running it through a banking program. So let's go down here. We'll do another one of these here in the beginning. Then I'm going to jump to the end and just kind of show you the end. And if you want to scan this and pause the video, you can certainly do that. I'm not going to go over every single purchase and all the numbers. You can kind of get the idea that it's going more and more in your benefit or in this person's benefit. So we're down here in year 12. She's still making her $10,000 annual premium deposits. She's put in 195,000 at this point. She now has cash value available to her of 230,000, and I say 230 because the 205 is actually factoring in taking out 25 to buy that car. So she's ahead of the game now of what she's put in to what's available to her. If you go over here, she would be behind $66,000 if she were to have normally made that payment to Ford Motor or Chrysler Capital. That's how much money she would have lost. And instead, she's ahead of the game, $261,000 at this point. And her death benefits to $1.2 million at this point. It's growing pretty nicely by now, which from the beginning has gone up about $300,000, $250,000 by this point, which is pretty cool. So let's jump down here. We're going to go all the way down here to her last car purchase. She's 72 years old. This is policy year 32. She's had this policy for 32 years. She's still making that $10,000 annual premium deposit. She's put in just a few $1,000s short of $400,000. She's bought that car for $25,000. Obviously, cars are going to increase in price over time. $25,000 isn't going to be the same car after 32 years, right? We're going to be talking about a lesser and lesser car. So we're not talking about inflation here. We're not even talking about her selling all of her previous cars. This is actually where she's buying the cars and keeping them. So she might be one of those people that has purses and shoes to match all the cars. Maybe she's super stylish like that. She's got a garage full of 7 cars here by the time she's 72, and she's one hip grandma, you know? So at this point, though, she's got available cash value of $864,000 plus the 25. So she's actually got a value available of, what would that be? $889,000 by that. So she's doubled, more than doubled what she's put in of $400,000. She's got in cash value available to her of $89,000, which is pretty significant. So we go over here. If we would talk about over 32 years of doing this, and actually be 31 of doing the policy loan and buying the cars, is $186,000 that she would be out. That much money is gone. But because she's put the money through this, and it's growing while she's making the $500 a month payment into this, that's ballooned to over $1 million by this point, which is a huge, huge shift. So when you think about just taking one of the things that is a bill or an expense in your life, in this case, it's a $25,000 car, and by putting the money in to fund that, and how that money grows over time and recapturing the payments, those two things combined grow to be $1 million difference in this person's life. That is a significant thing. And the thing to point out here is, I didn't talk about here in this column here, the cash value increase by year. In the first few years, it's because we're adding in 25,000. In these first few years, it's growing by more than 25,000. Once we drop down to 10,000, it's still growing at over double that. So you put in 10, and that year alone, it grew by almost $21,000. So by the time we get down here past, will just be the second into the third car, it's growing more than the $25,000 she's using in that year for the car. So she could be doing other things with this. She could be buying multiple cars. She could start making mortgage payments. And by the time she gets up into, 40s or 50s, she's probably got kids that are grown. Maybe she's got grandkids as you get later on in this. And this is the power of the banking. As you can see it in the beginning of, how would this affect my immediate life, me and my spouse, my business, the cash flow in that, how can I keep some of that cash flow from leaving my family and my business? When we get further along with this and you start seeing the numbers grow and you start seeing the potential here, you can actually, and this is what is taught once you get further along with this program, is you can become the family bank. So you might have children that they're ready to buy their first car or go to college or buy their first home. You can be the family bank. So instead of them having to go and get their mortgage or go and go get student loans, they can come to the family bank. And they have to prove themselves, obviously. This isn't a handout, but this is a financial wealth strategy generationally that the Rockefellers use. This book right here, I don't have the jacket on this, but this is, I don't know if I can get it up here to the light not reflecting, but What Would the Rockefellers Do by Gary Gunderson. This book outlines what I'm talking about. You can get to the point where you are financing your children's mortgage. They're making all the payments back to the family bank and keeping the money in the family generationally. So when you think about what I was talking about down here, at age 72, she's bought 7 cars. And because of the growth and the recapturing of payments, there's a $1 million difference in her life, in her family. What do you think could happen when you talk about this over a couple generations and you talk about maybe multiple kids buying multiple cars and maybe doing a mortgage? You could see this start ballooning up to maybe 5, 10, $15 million. And then you start talking about doing this for a third generation, and you might have 5, 10 grandchildren that are all doing this. Now you see how the Rockefellers have 2,200 of these policies in place for their entire family and their businesses and all that they have going on. This is a huge shift that I'm teaching to my children, or will, as they get more educated around money. They're pretty young right now, so they don't quite grasp money yet, especially at this level. But this is the power of it as you move along and start seeing outside of just what can I do in my immediate family with my spouse and in my business. It's a great starting point, but there's so much more potential beyond this. And obviously by year 72, or when this person's 72 and year 32, the policy's death benefit is going to be almost $1.7 million. So that would obviously transfer onto your estate. But the interesting thing with this is this person's got 7 cars, and she could be buying houses with this. If she was the family bank, like, she could be doing it for herself. Maybe she's got a few houses. Maybe she's got a condo in Florida or in Hawaii that she could be doing with this, because she's got all this cash value. She's got $864,000 in this year 32 when she's 72. She could be buying some things and paying herself back for some of that. And even by this point, she probably doesn't have a lot of income, so she wouldn't even need to pay herself back because it's growing so much and she's got so much going on for her. There's just a lot of possibilities with this. So we've done this example around a car, but instead of a car, you could take out car and put in vacations. You could put in training. You could put in equipment. In this type of flow, the numbers would obviously be a little bit differently. But the idea, the concept of the flow of money and how you run money through a bank first, recapture all the payments, and that money is growing for you over time is really the difference. So hopefully this gives you an idea of what the money can do, how these work, give you some idea of like, okay, what are all the things in my life right now that the money is flowing away from me? Bills, expenses, financing, leases, goals that I have, things I want to acquire, purchase, maybe it's vacations, could just be simple things like your insurance, your utilities. Obviously, cars and homes are the larger amount of our income that goes out typically to pay for those things. So you can really strategize, and that's what we're here for. This is to give you kind of a base of like understanding the flow of money, getting a little bit more comfortable with how this works and the possibilities. Hopefully you've had a few pings now of like, oh, I could maybe use it here, or I could use it here. But we're here as a resource. So certainly if this answers some questions, great. If you have additional questions or this brought up more questions, reach out. That's why we're here. We're here as your support system. We're here to strategize with you, help you make the best, strategies for you and your goals and your life and your financial situation. So hopefully this works out. I'm going to add a couple of last points here that just are important as we're talking about all this. When we're doing a policy loan, keep in mind up here, over here, it does tell you, excuse me, there is a policy interest that you're paying back to the insurance carrier of 4.76. And you ideally want to be paying that at the end of every year that you're taking loans. They'll send you a statement. I think my statement in the last 3 years has been, around $500-600, nothing real big. Just pay that off. And that is going back to the insurance carrier is a value exchange for them allowing you to do a loan against your cash value. So, and if you are watching this after the calendar change, or I'm doing this in 2021, 2022, this percent will become 4.08, and your policy will be growing a little bit less because there's been some IRS law changes. There's a little less growth and a little less interest that you're paying, but it's more beneficial when you're using it in a banking process because there's more cash value available in these new policies under these new laws. So if you have a policy that's been established prior to, say, October of 2021, and you're watching this, the percentages of growth inside your policy and the policy loan will remain the way they were. They're grandfathered in. They do not change based on the new laws. It's only new policies written pretty much at the end of 2021 or into 2022 that the numbers I'm talking about will be a little bit less. So hopefully that gains some clarity on that. But just know that that's also going on. We're having to pay a little bit of interest to be able to use the loan against our money, that line of credit against our collateralized cash value. And some people say, well, why would I want to pay interest on my money? Well, because it's allowing you to recapture the other 95% or 95.24% you're recapturing and adding to your wealth. That is a huge thing that you're doing. So you want to pay 4.76 so you can keep the other 95.24. That's the power of it. So hopefully this works. I didn't want to make a super long video. This is a little long. It's half an hour, but this is an important thing that really takes a lot to digest. So if you have questions, reach out, and we'll talk to you guys real soon. Take care.